Warren Buffett. For more than 60 years, you hear that name and you just think investing genius. But, now that he's stepping back, there's this huge question hanging in the air. What was his actual secret? And maybe even more importantly, can you still use his method today? Let's dig in. So to really get a handle on the legend, you have to start with the numbers. I want you to imagine you put just $100 into his company, Berkshire Hathaway, way back in 1965. Any idea what that would be worth today? It's almost unbelievable. $5.5 million. A track record that good? It really does sound like a myth. And, this story we all hear, the popular myth, is that Buffett is the ultimate value investor. He learned everything from his mentor, Ben Graham, and he got rich buying these kind of boring, unloved companies for less than their physical stuff, their factories and inventory was worth. And this early quote, it captures that philosophy perfectly. But what if that simple story, the one we all think we know, isn't really the whole truth? What if the real secret to his unbelievable success wasn't about buying cheap assets at all, but about something completely different? Okay, the key to cracking this whole thing is to realize that Buffett's strategy wasn't set in stone. It changed. It evolved. We're going to trace his journey from that classic value investing he learned as a kid to mastering a totally different and way more powerful kind of asset, something called goodwill. And you can really see this evolution if you break his career down into 3 distinct eras. What's so cool is they perfectly mirror how the American economy itself was changing. He started out with industrial-age companies like Geico, then he pivoted to these huge consumer giants like Coca-Cola, and finally, he landed on an information-age titan, Apple. And just look at this contrast, it's night and day. In 1976, he buys Geico for less than half its tangible book value, a total old-school buy-the-book purchase. But then, just 12 years later, he buys Coca-Cola for over 4 times its book value. I mean, he clearly wasn't buying its bottling plants, he was buying its brand. And his investment in Apple, well, that was the final stage of this whole evolution. I mean, think about it for a second. Apple's real value isn't in its buildings or its inventory. It's the intellectual property, that powerful ecosystem that locks you in, and the network effects of billions of users. It's the ultimate business built on things you can't touch. And here's the wild part. Buffett told us this was happening. As far back as 1983, he literally wrote that his thinking had totally changed. He wasn't hinting for tangible assets anymore. He was now on the hunt for businesses with enduring goodwill that needed hardly any physical stuff to thrive. This chart right here really shows you what happened because of that shift. Back in the late 70s, his portfolio was built on a foundation of tangible capital, factories, equipment. But you fast forward to today, and that foundation, it's been almost completely swapped out for intangible assets like brand, patents, and network effects. So here it is, the knockout punch. You can forget that idea of Buffett buying stocks for pennies on the dollar. A staggering 92% of his major investments since 1978 were bought at a premium to their book value. So yeah, the myth of the cheap stock picker, it's officially busted. Okay, so if it wasn't about buying cheap stocks, what in the world was it? Well, what's so interesting is that we can actually perform a kind of quantitative autopsy on his entire portfolio to find the repeatable patterns, or factors, that really explain his success. And to put it simply, factor investing is really just about identifying specific, measurable traits. Things like a stock being high quality or having strong momentum that have historically led to better returns. And then you just build a portfolio around companies that have those traits. It's a system. And when we apply that system and break down Buffett's returns, this is what we find. The 2 biggest drivers of his incredible outperformance were his focus on intangible value and on quality. His pure, unexplainable stock-picking magic, what finance nerds call alpha, was actually responsible for a surprisingly tiny piece of his success. So I want you to let that sink in for a second. 87% of what we call Buffett's genius isn't some unknowable magic trick. No, it's a repeatable, systematic strategy focused on 2 core ideas that literally anyone can identify and understand. So that brings us right to the secret itself. His entire modern philosophy, it can be boiled down to this really powerful combination of just 2 factors. Let's break down exactly what they are. So the first factor is intangible value. This is all the good stuff that makes a company truly great but doesn't actually show up on a standard balance sheet. Think about the power of the Coca-Cola brand or the value of Apple's patents. That's intangible value.
The second ingredient is quality. Now, this one's a little simpler. It just means finding companies that are financially strong and super profitable. These are the businesses that are already winning, the ones protected by what Buffett famously calls their durable moats.
And that's it. That's the formula. It's that simple. He looks for high-quality businesses whose dominance comes from these powerful, hard-to-replicate intangible assets. That right there is the secret sauce. And the proof is right here in the pudding. This chart shows just how ridiculously powerful that two-factor formula is. A simple, automated portfolio that only buys companies with high intangible value and high quality has, historically, generated returns that are remarkably similar to Buffett's own.
So, what does all this mean for us, right, as investors today? Well, it means that Buffett's true legacy isn't the giant company he built, but the principles that anyone can learn from and apply.
See, the reality is, Berkshire is now so unbelievably massive, it faces what you could call a trillion-dollar challenge. It can only invest in the absolute biggest companies on the planet, its old hunting grounds are shrinking, and it's sitting on this record pile of cash simply because it's too big to find enough great places to put it.
But here is the most important point of all. While Berkshire, the company, is stuck because of its size, Buffett's principles are not. That two-factor formula, combining intangible value and quality, that can work absolutely anywhere. And the data completely backs this up. The two-factor model has beaten the market not just in Buffett's traditional comfort zone, but also in tech stocks, in international markets, and even in small caps. All these areas where Berkshire itself is now just too big to invest effectively.
Which really leaves us with this one last fascinating thought. As the man himself steps away from the stage, is it possible that his real strategy, this distilled, powerful framework that anyone can use, is actually just getting started? Maybe Buffett's true legacy isn't the empire he built, but the map he left behind for the rest of us to follow.